This is Finance Spotlight, brought to you by ThinkSpace Media. Money management is the key to improving or maintaining your financial situation. Each of us has our own particular relationship with money. Some want as much of it as possible and devote significant time and energy to its pursuit. Others prefer to live simply on minimal resources. Perhaps most of us fall somewhere in the middle, wanting to live comfortably without sacrificing the quality or balance of our lives. No matter what you want your money to do for you, learning the basics of money management will help you make it happen. With that in mind, let's take a look at the most important rule of money, Finance 101. So be calm and watch the full video, and don't forget to subscribe, like, and share your thoughts in the comments sections. The most important rule of money, Finance 101. Number 1. Set short-term and long-term goals. Building financial security is an ongoing juggling act. Some of the money balls you have in the air are going to be goals you want to reach ASAP. Other goals might have an end date that is a decade or decades off, but require starting sooner than later. Creating a master list of all your goals is a smart first step. It's always easier to plot a course of action when you are clear on what you're looking to achieve. It's up to you whether your list of short and long-term goals is on a spreadsheet or pencil to paper. Just be sure to give yourself some quiet time to think it through. Here's a simple prompt. Money-wise, what would make you feel great? At its heart, that's what a financial plan delivers. The means to help you feel safe and secure so you can focus on living, not worrying. Possibilities to consider. Short-term goals to reach in the next year or so. Build an emergency fund that can cover at least 3 months of living expenses. Keep new credit card charges limited to what you can pay off in full each month. Hint: create and follow a budget. Pay off existing credit card balances. Longer-term goals. Start saving at least 10% of gross salary every year for your retirement. Save for a home down payment. Save for a child's or grandchild's education in a tax-advantaged 529 plan. Create a budget. Not exactly a sexy topic. Agreed. But creating a budget happens to be the one step that makes every other financial goal reachable. A budget is a line item accounting of all your income, salary, maybe a side gig, perhaps income from an investment, and all your expenses. The whole purpose of a budget is to lay everything out in front of you so you can see where everything is going and make some tweaks if you're not currently on course to meet your goals. One way to analyze your current cash flow is to run it through the popular 50-30-20 budgeting framework. Build an emergency fund. Okay, you likely need no convincing that having some money tucked away for life's endless stream of financial curveballs, pandemic layoff, the deductible for an MRI on the knee you wrenched, replacing whatever the mechanic tells you is the reason your car is acting up, is perhaps the ultimate money stress reducer. But how to create your safety cushion? You've got plenty of stressed out company. A survey by Bankrate.com found that 60% of people say they don't have enough money saved to cover a $1,000 emergency bill, and just $1,000 isn't likely even enough. Bankrate said that among survey participants who had an emergency in 2019, the average tab was $3,500. Building an emergency fund starts with setting a goal for how much protection you want to build. At a minimum, it's smart to have at least 3 months' worth of living expenses saved in an emergency account. 6 is even better. The best way to achieve this is to open a separate bank or credit union savings account that you designate as your emergency fund. Keeping this money in your regular checking account introduces the temptation to use the money for non-emergencies. Pay off costly credit card debt. The unofficial term for the interest rate charged on unpaid credit card balances is insane. While it's common for banks to pay savers less than 1% interest these days on savings accounts, the average interest rate they charge credit card users with an unpaid balance is pushing 17%. Paying off high-rate debt is one of the best investment moves, and the average 17% interest rate charged on unpaid credit card balances is a big roadblock to building financial security. If you have a solid credit score, you might consider checking if you can qualify for a balance transfer deal to a new card that will waive interest payments for an initial period. Not having to pay any interest for a year or more gives you a chunk of time to make a big dent in repayment without interest continuing to pile up. Save for retirement. Even if you have decades to go until retirement, the time to get started saving was yesterday. The longer you wait to get serious about this big honking goal, the more you will need to contribute to land in retirement in good shape. There's no one rule for how much you'll want, read need, to save for retirement, but a solid guideline is to have a multiple of your salary set aside at different ages. As you can see below, having retirement account balances equal to 2 times your salary by age 35 sets you up for success. When you're 50, the aim is to have 6 times your salary in a retirement account, and by your late 60s, having 10 times your salary saved up is recommended. Invest for retirement with a long-term focus. What you manage to save for retirement is the biggest factor in how comfy you're going to be when it's time to step off the work treadmill. But how you invest the money in your retirement accounts plays a large role too. Saving for retirement breaks down into how much you want to invest in stocks and how much in bonds. As if this needed pointing out now, stocks can be volatile at times, though over long periods, 10 years or more, they have historically delivered higher returns than bonds. Bonds are more chill. They don't fall like stocks in rough times. In fact, they typically rise when stocks are cratering. However, they don't gain as much as stocks either. A hidden risk to consider when you are deciding on your mix of stocks and bonds is inflation. That's the annoying fact that, over time, stuff costs more. Even at a benign 2% inflation rate, what costs $1,000 today will cost more than $1,600 in 25 years. Stocks over long stretches have produced the best inflation-beating gains. Borrow smart big-ticket purchases typically involve taking out a loan. The house you want to buy, the cars you drive, helping your kids pay for college. The key to building financial security is to only borrow what you truly need. And that can get tricky because right when you're looking to buy a house/car/college education, the lenders are focused on telling you the maximum you are allowed to borrow. No one is going to look you in the eye and suggest you borrow less. Lenders have no clue or interest in how the loan they are dangling in front of you impacts your ability to meet all your other goals. This is Finance Spotlight, brought to you by ThinkSpace Media. If you found this video insightful and are eager to learn more about achieving financial milestones, don't forget to subscribe to our channel, like this video, and share your thoughts in the comments section below. Together, let's start on a journey towards financial success.